Hey everyone, welcome back to Corporate Decoded, the place where we decode complex financial documents to give you the inside scoop. You know, the kind of scoop that makes a company look like it's flying high or really struggling to stay afloat. Get ready, because we are diving deep into Dropbox Incorporated's latest annual report. And let me tell you, there are some numbers in here that tell a very interesting story. So, buckle up and join me as we unravel the financials, the risks, and what it all means for Dropbox's future. Before we jump in, if you love getting these clear, concise breakdowns of financial filings, make sure you hit that subscribe button and the notification bell so you never miss an episode. And if you want to chat more about these filings and connect with other finance enthusiasts, check out our Discord community linked in the description below. Now let's get started. So this annual report for the year ending the 31st of December 2025 tells us a lot about where Dropbox stands financially. Let us kick things off with a quick look at their balance sheet. You know, the snapshot of what they own and what they owe first. Take a look at their cash and cash equivalents. They had $891.3 million at the end of last year, down from $1.3 billion. Year before that tells us they spent a good chunk of cash, which is not necessarily bad if it's invested wisely, and we will look at that in a bit. Now let's talk about revenue for the year ending the 31st of December 2025. Dropbox brought in $2.521 billion. That is actually a small dip from $2.548 billion in 2024, and the report says this was mainly because they decided to cut back on investing in FormSwift and face some challenges with their team's products. But on the bright side, their individual plans grew a little. But here is where things get a little more interesting. Their cost of revenue jumped up significantly by 12.5% to $500.8 million last year. This increase was largely due to higher infrastructure costs, probably meaning more spending on servers and data center stuff. The report mentions a data center refresh cycle, meaning they are upgrading their equipment, so that expense makes sense, but it did eat into their gross profit margins. Now, what about innovation? They slashed their research and development expenses by a whopping 20% down to $732 million in 2025. The report claims this is due to becoming more efficient and cutting headcount. That is a big cut. And while efficiency is good, it makes you wonder if they are slowing down their innovation engine to save money. And look at sales and marketing expenses, also down by almost 20% to $369.9 million. This drop is attributed to reduced advertising spending, again linked to their strategy to really dial back on FormSwift, and also fewer employees in this department. So across the board, it's clear they are focused on cutting costs and becoming leaner. But here is the punchline: despite the drop in revenue, and the cost-cutting measures, their income from operations actually grew significantly, up to $689.1 million from $486.2 million in 2024. That is a solid 41% increase. This means their cost-cutting efforts, though aggressive, are paying off in the short term. They are making more profit on the revenue they do have. And that healthy operating income translated directly to their net income, which rose to $508.4 million in 2025, from $452.3 million in 2024, an increase of over 12%. So while growth might be slowing down, profitability is definitely on the rise, which is a common strategy for companies in a mature stage. Looking at their key metrics, total annual recurring revenue, or AR, took a slight hit, falling to $2.526 billion in 2025 from $2.574 billion in 2024. The report attributes this directly to their decision to reduce investment in FormSwift, and a tough market for their teams plans. This shows a clear trade off they are making, prioritizing profitability over some aspects of growth. And what about their customers? The number of paying users also saw a small decrease from 18.22 million in 2024 to 18.08 million in 2025. Again, the same factors are cited: less sales activity after workforce reductions, and their FormSwift strategy are the main culprits. This is a trend to watch if they can't reverse this user decline. It could become a bigger issue. However, on the flip side, their average revenue per Pascal Ying user, or ARPU, actually decreased slightly for the year ending the 31st of December 2025 compared to 2024, going from $140.23 down to $138.91. This might seem counterintuitive with cost cuts, but the report suggests it is because more customers are opting for lower price plans, and again, their FormSwift strategy with its pricing is a factor. This indicates a potential challenge in getting users to upgrade to higher value offerings. But let us talk about cash flow, which is king here. Their free cash flow, a measure of cash generated after accounting for capital expenditures, increased nicely to $930.8 million in 2025 from $871.6 million in 2024. This is a positive sign, showing they are generating good cash even with reduced revenue growth. It seems their operational efficiency initiatives are really working here. Now, looking at their liabilities, specifically their current liabilities jumped significantly to $1.89 billion in 2025, up from $1.21 billion in 2024. A big part of this increase is actually because of their convertible senior notes, which are now listed as a current liability, meaning they are due soon, or at least the accounting is classifying them that way. This jump in current liabilities, along with a nearly doubled long term debt, is definitely something to keep an eye on. Speaking of debt in 2025, their non-current term loan balance ballooned to $1.43 billion, up from $962.9 million. In 2024, this shows they have taken on quite a bit of new debt, which will mean higher interest payments down the line, which we actually see reflected in their financial statements. And there it is, their interest expense increased dramatically from $13.9 million in income in 2024 to a hefty $78.6 million in expense in 2025. This is a direct consequence of that increased borrowing, and it is a significant drain on their net income. Interestingly, they recorded a net gain on real estate assets of $1.3 million in 2025. This seems to be due to some positive sublease activity for their San Francisco headquarters, which is likely a result of their embrace of remote work. This really highlights how their shift to a virtual first model is impacting their physical footprint and their financial reporting. Back to those notes, they have a massive $695.4 million in current convertible senior notes and another $689.9 million in non-current convertible senior notes. These are major financial obligations that will require careful management. Now let's quickly touch on risks. Dropbox acknowledges their growth rate has declined and warns that if they don't successfully execute their new product initiatives, they might continue to see slower growth or even negative growth. That is a pretty direct statement about their current challenges. The report also heavily emphasizes the risks associated with privacy and data security breaches, mentioning a specific incident with Dropbox, signed last year, and ongoing litigation. This is a constant battle in the tech world. They're very clear that their virtual first workforce model creates uncertainty about its long-term impact on their finances and how their business will operate. It could be a brilliant move or a costly experiment, but they are still figuring it out. And a major vulnerability they call out is their dependence on other companies for their platform to work seamlessly. If partners like Apple or Google change their systems, it could really hurt Dropbox. So wrapping up the financials for Dropbox in 2025, it was a year of strategic cost cutting and reorientation. While revenue saw a slight dip and paying users decreased their profitability, improved significantly thanks to those efficiency drives, and a focus on higher ARPU offerings, the 2025 results show a company prioritizing financial discipline, perhaps to navigate economic uncertainties or to fund future growth from a stronger base. The increased debt and interest expenses are a significant consideration, but their strong free cash flow generation is a very positive sign. Their future success will largely hinge on their ability to re-accelerate user growth and successfully innovate, especially with those AI initiatives they are investing in, while managing their substantial debt load and the inherent risks of their business model. What is my take on all of this? Well, Dropbox is clearly in a transition phase. They are making tough but potentially smart decisions to become more profitable and manage risk. They are simplifying their operations and focusing on their core strengths. The biggest challenges ahead will be reigniting user growth in a competitive market and effectively leveraging their AI investments without jeopardizing their financial stability. Their virtual first model presents both opportunities and significant unknowns. The substantial debt is a concern, but their ability to generate strong free cash flow offers some reassurance. Ultimately, they are betting on efficiency and targeted innovation to drive future success. So what do you think of these cost cutting measures? A sign of strength or weakness for Dropbox, especially with that ARPU dip? Let me know your thoughts in the comments below. If you found this breakdown helpful, make sure to smash that like button and subscribe for more deep dives into the world of corporate finance. And as always, check out the Discord server linked in the description to keep the conversation going. Thanks for watching, and I will see you in the next video.